Good morning, friends. Good morning, friends. Okay, welcome you all to Bharadwaj Institute. So today we're going to start with your AFM classes. So initial maybe some 15-20 minutes. Let me talk a little bit about the subject and then we proceed to the core subject. So initially, let me just give some intro about the subject. Now, this is going to be an extension of what you did at CA Inter. You would have gone through a paper called as Financial Management. An extension of that is what is Advanced Financial Management. Our classes are going to be for the new syllabus. I'll first maybe touch upon a little bit about the old syllabus vis-a-vis the new syllabus because some of you could have completed your classes in old syllabus or you could have gone through some bit of it there. For most of you, it could be a fresh classes as well. It doesn't make any difference because our classes are going to be exclusively for new syllabus. So it's going to be a clean slate approach. That is new preparation for most of you. For some of you, if at all you have gone through earlier, as to what you need to do, that part also I'll touch on. Now, coming to this part of advanced financial management, this ICI has introduced your new syllabus wherein the applicability starts from May 24 onwards. So, this is one subject which does not undergo many changes. So, whether you're writing May 24 or November 24 or May 25, November 25 wouldn't make a big difference in any of the attempts you write it because broadly the concepts remain same, broadly the content remain the same. Some new problems here and there I'll keep adding, but otherwise the core content is going to remain same. In fact, if you have already gone through my classes in old syllabus, you may see a lot of similarity between that and what I'm going to cover now because there is going to be at least 90% overlapping, 80% overlapping I can say. Balance, obviously there are some changes which are there. Now, as compared to the earlier syllabus which was there, there's one fresh chapter which has been added called as capital budgeting, which obviously you learn at CA Inter. At CA Inter, if at all you have gone through the latest syllabus of CA Inter, because there was an IPCC earlier, there was PCC earlier, depending on which you have gone through. If you have gone through the latest syllabus of ICA, that is the latest CA Inter, you would have gone through two chapters there. There's something called as capital budgeting and risk analysis in capital budgeting. ICA has removed that risk analysis and capital budgeting from Inter and moved it to final. That's the thing they have done. And obviously capital budgeting, some newer problems, some extended questions, all that has been added. But broadly, this is what ICA has done. They've removed one area from your CA Inter and moved it to CA Final. Obviously, the intensity of question, the complexity of the question at CA Final is obviously at some different stage as compared to what is there at CA Inter. Apart from that, every chapter, some additions here and there have been done. The major change, according to me, is one MCQ of 30 marks got added. This is the major change which I believe is going to have significant effect and it's a welcome change. In fact, internationally, if you see most of the courses, a lot of courses have moved to even MCQ 100 marks rather than 30 marks. They've moved to MCQ even 100 marks. Your CFA or your CPA, most of them work through this 100 marks MCQ. Now, why MCQ is good? Because that is the only area which can test your clear conceptual clarity. Whether a student understands concepts or not, the best way of testing that is the through MCQ mode rather than giving you a descriptive question, where also MCQ ensures one more thing, that there will not be any evaluation bias, because a lot of times we have a worry saying that my solution is slightly different, ICA solution is different, I follow a different pattern, ICA follows a different pattern. All the challenges are moved out with MCQ coming in. So that's a good change which has been brought in. MCQ of 30 marks is going to be there. Apart from that, balance 70 marks as of now looks like a question mark. How they are going to test, what is going to happen, we are not very sure. So as things progress, because as ICI releases some RTPs, MTPs closer to your May 24 attempt, we'll get more clarity as to what they want to really do. Because the earlier syllabus, I'll go back to maybe to the erstwhile syllabus, the existing syllabus. There was an old syllabus before that. At that time, I used to tell students not to prepare theory because theory used to be an optional question. Then came your the existing syllabus which is going on as of now, where I tell students to prepare theory also because theory is mandatory for you to attend. I don't know what is going to happen in your May 24 onwards, whether theory is critical or not. But whether theory becomes critical or not, see, there are two things. One is remembering theory, which is very critical in case a student wants to answer a descriptive question. Second is understanding the theory very clearly. That is needed to answer MCQ. So anyway, theory you have to go through because you will have to have clear understanding on concepts. What is securitization? What is credit default swap? What is CDO? All this I'll touch upon later on in the theory part. So somewhere you need to know what are these concepts. So that becomes very clear that you need to have idea of these items. But whether I need to reproduce it or not depends on whether ICA is going to test theory in exam or not. So that we'll touch upon later on because clarity will emerge as we proceed. So MCQ is going to be 30 marks, balance 70 marks, could be practical questions, could be combination of practical and theory. Things will emerge as we proceed. Now in your subject of AFM, we broadly have 15 chapters. Earlier it used to be 14 chapters, now you have 15 chapters in which I think 5 chapters are purely theory based. Chapter 1, 2, 3, 7 and 15. I think that's the number I remember. But broadly 5 chapters are going to be fully theory based with some practical here and there. Some problem solving could be there. But predominantly theory based areas are those. Apart from those, there are 10 chapters which are significantly descriptive based papers where you have multiple concepts which you are going to learn. The focus at final level is one. I think the broad classification I can do is you will have to learn about valuation. That is one important area which any valuer or any financial manager, any person who has an understanding of AFM is expected to do. So you will learn about valuation in multiple chapters. You learn about this in security valuation. You learn about this in corporate or business valuation. You're going to learn about this in mergers and acquisitions. So valuation is one critical aspect of this aspect of your paper. The second aspect which you're going to learn about is Forex. Forex is what we cover in Forex and all. I'll touch upon later. Let's just understand broadly what is there. So valuation, Forex, derivatives, and portfolio, and maybe mutual fund. These are the 5 chapters which are there. I think valuation gets discussed in 3 chapters. So you have something called as a security valuation. You have something called as a business valuation. You also have something called as mergers and acquisition. All the 3 same thing. Here and there I'll keep touching upon different aspects, but broadly the same concepts are going to be there. So initial bit of our classes is going to focus on valuation, which will go on for maybe 15 to 20 classes. I think more than 20 also. It can go on around for 20 classes. We'll discuss about valuation, where we discuss 3 chapters. One is your security valuation, second is going to be your business valuation, and third is going to be your mergers and acquisition. Then Forex is discussed in 2 chapters for you. So we have something called as your normal Forex, and there's something called as capital budgeting or investment related angle of Forex. So Forex you are going to discuss in 2 chapters. Derivatives discussion also will happen in 2 chapters. One is called as normal derivatives and second is called as your interest rate related derivatives. So derivatives discussion will also happen in 2 chapters. Then you have something called as portfolio management, mutual funds, and your new addition called as capital budgeting. This is the broad breakup of your syllabus. At a financial manager or a CFO is required to have advanced understanding or expert knowledge of these issues. So it's not the basic knowledge which you would have got at CA Inter. An expert knowledge is needed in all these areas. Also, an understanding of this is very critical because most of the students or many people want to get into a profile or work related to corporate finance. These are the lucrative areas. Many students, most or many qualified chartered accountants, in the initial plan is that I'll do something related to investment banking, something related to valuation, something related to corporate finance. So the base of that is going to be set here. Whatever base understanding you're going to get here is going to be extensively used later on. One challenge with this paper is, unfortunately, you will see rarely concepts related to your advanced financial management in your articleship exposure. Very rarely you will see something related to this. If at all something related to Forex, when you're doing some audit, some transaction you may see. But otherwise, AFM is going to be like lot of theoretical aspect. I'll try to give you some practical examples here and there. Try to show you how stock prices move, try to show you with some practical companies, but a lot of challenges are going to be there in this aspect only because you don't see this in your articleship exposure. What you see in maybe some other subject like taxation, be it direct, indirect, or be it law, be it audit. You do see that in the practical world as part of your articleship exposure. But this is one area where the articleship exposure may not help you that much, or you may not see this in the practical world. So that's a challenge we'll try to address to the extent possible. Now, before I start with the subject, I have few basic expectation from you guys. I think most of the people who have been my past students know my expectation. So expectations are very clear. I want you to be there at 6 o'clock. So please, let's not be late to the class. You be late to the class. When you come in, you disturb others, you disturb me also, and you also get disturbed. So everyone gets disturbed because you come in late. So let's start our class at 6 a.m. Most of the days it will start at 6. I will ensure that I don't come late. But in case there are some challenges, I'll update that in the group. But otherwise, we'll start at 6. Second thing is be regular to the class. That's the most important part. Be regular. Just go this side. This side. Be regular to the class, because attending your classes regularly is going to be very, very critical. I'll also tell a point. Some of my students are going to watch recorded videos. This is not for you guys, but for people who are watching recorded videos. Ensure that you watch classes with the proper schedule. So the main challenge with the number the main challenge which happens is students don't have a systematic schedule which is there. So you need a systematic schedule for your preparation, even if you're watching classes or attending classes. In fact, I'll tell you, people who have come for face-to-face classes, the reason why people opt for face-to-face classes is there is a specific schedule which I give, and you're required to follow that specific schedule. Unfortunately, it is your laziness. When I say it is your laziness, if today there was no class, you wouldn't have woken up by this time and gone through this 3 hours of preparation which we are going to go through. So one, I give you guidance, but the other aspect is, because you are not disciplined enough, that is the reason why you are forced to come to the class. Because if I say no class tomorrow, you'll not wake up at 6, you'll not wake up at 5:30 and do your preparation. You're not doing preparation for Dinesh Jain, you're doing preparation for yourself. It's not that Dinesh Jain has to stand here and then only you'll have to do your preparation. So whether I'm standing here or not standing here, in case there is no class on, because there's no class on Tuesday, doesn't mean you can relax. I can relax. I'm not going to wake up at 5:30 and then say there is no class, so still I wake up. I'm not going to do it. I can afford to do all that because I'm done with my course. I can do whatever I want to do. But at your end, the expectation is going to be that you do your preparation on a consistent basis. Doing daily preparation is going to be very, very critical, whether class there, not there. Obviously, in a week you want to relax for a day, I can understand, but otherwise normal expectation is that you do preparation along with the classes, because I'll give you a lot of homework. So I'm going to give you a lot of homework, whether you like it, you don't like it, but there is going to be a lot of homework questions which are going to be there. So that's going to be there. Apart from that, there are going to be MCQ level quiz which I used to conduct. I'll share you at some stage you will get an MCQ book, whether it's a soft copy or hard copy, we'll see it later, because it's under preparation. Till now I prepared some 450 MCQ questions. I want to add and make it 1000 or 1500. So that's the stage I want to reach that book to. So that is something which will come to you at some stage. But as I complete a topic, when I say we are going to start with a chapter called security valuation, but that will be broken down into 10-12 topics, because security valuation is so vast. So when I break it down into 10-12 topics, every topic will have an MCQ test for you, which I'll share a link to you. You can take test at your own leisure. It's going to be an online quiz. You answer it. At the end of the quiz, you will get your marks. You'll also get explanation as to whatever questions are there. I used to force this even for my earlier students, but now there's no choice, because MCQ is part of your paper. So obviously you will have to do it. So earlier I used to push a lot, because MCQ is the only way to test conceptual clarity. I want to complete this security evaluation. I can complete it in 3-4 classes by just discussing MCQs, because MCQ will test all the concepts. But obviously descriptive are there in paper, so that's why we're going to discuss your detailed question. But technically, your MCQs are the easiest way of testing your clarity. Just go this side. MCQs are the easiest way of testing conceptual clarity of any student. So there are going to be a lot of MCQ tests which are going to be there. So homework is going to be there. MCQ test is going to be there. Apart from that, I don't see much of requirement from your side. So one is completing your homework, completing your MCQ part, that is the only thing, and obviously being regular to classes and be there at 6 a.m. These are very simple expectation which I have. Don't come back to me later saying that my articleship is extremely time consuming, I get tired, I get this, I do that. I don't want to hear excuses. I'll add on to excuses if you want, but the problem is, as I said, AFM is one paper where your articleship exposure may not help you much. So you are brilliant in your articleship. Your principal is valuing you. He is praising you. ICA finally says, please get 40 marks in every subject and get 50 marks in your aggregate. So whether you do excellent in your articleship or you don't do excellent in your articleship, ICA is not bothered about it. Obviously, articleship is very valuable. I really appreciate that, because that is the only thing which distinguishes the scores from others. So you give attention to that. I'm not at all saying no to you. Give attention to your articleship exposure. Do everything what is needed there. But obviously, this also needs some attention. This also needs to be valued by you, because ignoring this is not going to be acceptable. Go to come this side and move. Ignoring this is not going to be acceptable. And if you do something for your office, please also do something for yourself, because this is something which you need to do for yourself. You're doing great things for your office. I appreciate that. I'm very happy about it. But at the end of the day, this also needs to be given its own attention. So that's the basic thing which I wanted to touch on, saying that I have certain expectation from you. I also have certain expectation, one more expectation for the initial few classes. Students who have attended my classes will know, at places I go a little faster. Well, that's my nature, but at places I may go a little faster. Give me feedback. Instant feedback is what I do appreciate. In the class itself, if you tell, great. After the class, face to face, you tell, great. Otherwise, you send me a message in WhatsApp, great. We'll also be asking you anonymous feedback, but don't wait for anonymous feedback, because that will be at some stage. So you tell me after 15 classes saying, sir, I did not understand anything because you were going faster. I cannot repeat those 15 classes. So be open, give me instant feedback so that I can make corrections which are needed then and there. There's no point in giving me a feedback after, because you give me a dated feedback, I can implement it, but it will be later on. So at any stage you are facing challenges with the speed aspect or any aspect, anywhere there are challenges, please be open and give us the feedback so that we can work on those feedback. So that's the initial few classes. I'm very particular about getting feedback, because I need to know whether my speed is fine, not fine, and I'll get to know from only you guys. Clear? Done. I'll be now moving on to the subject, but anything else you guys have, any expectation or anything you want me to address or you have, let me know, else I'll start with the core subject. Okay. So we're going to start with the core subject. We're going to start with valuation today. That's the area we are going to do. I'll first broadly discuss about valuation, and then later on we'll move to the finer areas which are there in valuation. As far as your okay, also I'll talk about the books which have been given to you. You would have got this workbook on AFM. This workbook is one part of it which you would have got. The second thing which you would have got is an SFM book. It will say SFM. Don't worry about why it is called SFM. The reason why I've given that book is, at that stage I normally have a practice of giving question as well as the answer. At this stage I'm not able to get answers to all the question. I'm not able to type, and time constraint is there. So questions are ready, answers are not ready. I think your material will have some 600 questions or so. Of that, around 500 question answer would be there in that book which has been given to you. So that book has only one purpose. In case you want to check solutions for few questions, you can check the solutions there. Capital budgeting solutions will not be there in that book. Other chapter solutions will be there. That book also has theory, everything. Ignore all that, because there are changes which have happened. So the main book is going to be Advanced Financial Management. This book which has been given to you, this book is what you need to see. At some stage, if my solutions are ready for the balance question also, I'll see how I can provide it to you. But at this stage, solutions are not ready for all the questions, because it is taking time at my end to prepare the solution. I wanted to give you the book, so I have given you this workbook. This is exhaustive. Here also I may add few questions in two topics where I have sent a mail to ICI. I'm asking for some clarity from them whether those topics practical questions are needed or not. I'm yet to get a revert on that. So once I get an understanding of that, I may add few questions. So that's one part. The solutions to this could be in there in that big book which is there. You need not bring that book to the class. You can keep it at home whenever you want to look at the solution for some question. Exact mapping of question number will not be there, but most of the solutions will be there. So exact mapping may not be there, but most of the solutions are going to be there in that book. So that's the purpose that book is going to serve. Because I also give some homework. So for homework, you want to check the solution, you have to check the solution in that book only. So for solution checking, that book is going to be useful. Apart from this, as I said, I may give you an MCQ book and something called as a last day revision material. So that is, these two are under preparation, will take me at least a month's time is my sense. So I cannot stop that. So we are going to start with the classes in a month's time. I hope I am done with the MCQ book. Whether I'm done with a month's time or a 2 months time, but before your classes get over, you will get those books either in the soft copy mode or a hard copy mode. That I'll check and let you know later, but you will get those two materials which are needed. So with that, your complete coverage of AFM would be there. I don't expect you to refer any other book. So my expectation is, please don't refer any other book. If at all you want to refer your ICI material. But unfortunately, when you refer your ICI material, you will say this guy has copy pasted most of the stuff. So my book will be a copy paste of your ICI material. So you will at some stage feel that he has copy pasted most of the stuff. What is the point of going through the ICI material, or what is the point of going through my book? Whatever it is. So your wish. But you want to go through ICI material, please go through it. I don't have a problem. But at some stage, you will get a realization, because 95% of the questions would be covered here. ICI material has, I think, some 300 questions. My book has some 600 questions. So there are obvious additions there. And your theory, concepts, everything I have summarized and kept it here. If somebody wants to read in detail about the theory, obviously please go through your ICI material. That's the source for your preparation. So that is something you can do. But at this stage, I don't expect you to buy any reference book. Please don't spend money on that. Don't buy any reference book. Money is one part. Time is also going to be a significant factor. So that's one thing. And one more challenge which we'll have in this AFM subject is, there are going to be, I think, some 5 to 10%, I'll say 5 or 10% of the question where our solution, either I'll match the ICA solution. If I match the ICA solution, there could be some illogical issue there, or I will not match the ICA solution where it is impossible for me to match the solution, because I am not able to give any logic for the ICA solution. So I'll not be matching the ICA solution. I'll be giving a different answer. I'll let you know all those questions later on. So that is one challenge. So don't keep worrying about this 5-10% of the question, because most of the doubts of the students come to me saying that, why did we do this? My answer would be, I told in the class that this question is illogical. I cannot give you a logic for this. So few questions are going to be there that some students expect me to give the logical answer. I have tried giving the logical answer, but ICI doesn't award marks. So there are challenges. So I will have to ensure that you clear your paper. I'll discuss the logical aspect, but some stage I'll tell you that few question, please follow what ICI has done. So that's as far as broadly the subject is. Let's now move to security valuation. Page 57 is what we are going to discuss. You can collect it later also. In case you have not got the book, you can collect it later, and please sign that sheet which would be there. And if your name is not there, just add name. Okay, now we are going to discuss about security valuation. Let's first discuss broadly what is valuation. Valuation is finding out value of anything. For example, I want to know what is the value of this property where I am standing. Now, can you tell me what will be the value of this property? Just some broad number, that's okay. You can give me any number. I'm not going to give you, I'll just ask you some questions after that, so that our discussion reaches a stage where I can introduce valuation to you. So what should be the value of this property? 10 crores, okay. 10, 5, 4, whatever number you want to do. Okay, can you tell me on what basis are you giving me this value? So when I ask you what is the value, some things would have gone in your mind, no? You would be thinking about certain aspect. So how are you arriving at the value of this? Okay, area. What else? Demand. Okay. Please participate, please. I need participation, else I can keep talking about it. If that's the requirement, then you can just see the screen also, because there are recorded classes. You just see the screen also then. So please, I need participation. Right, wrong, and all doesn't really matter to me. Value of similar property, okay. Amenities, okay. What else comes to your mind? I'm just waiting for one more point. Area is there. That is the area square feet, I assume, and the location. That's okay. Okay. What else? The amenities are the how connective it is. So I get to the transportation aspect. Demand is there. How much? Sorry, revenue. Yeah, this is one aspect which I was waiting for. Revenue from the property. So there are multiple aspects based on which you will do a valuation. Now in the practical world, we do valuation based on multiple things. First thing is based on, no need to write anything. In case you want to make running notes, you can make it, but I'm just discussing the broad concept. Focus should be more on understanding it. Writing part, in case you want to make running notes, it's up to you, but most of the concepts would be there in the material, but still you want to make running notes, you can make it. One is based on assets value. Based on the assets value, that is, I want to compare this with similar property. I want to do area square feet into the rate per square feet. I do want to do all that calculation and then get to this. Second is based on income generation. How much income can it generate? Based on that, we are trying to value this property. Third, it's similar to based on income, but we call it as based on cash flows. It is similar to your income only. In case of this building, if at all I'm preparing an income statement, then I'll claim depreciation. So one based on PAT you can do, second based on cash flows you can do. Why cash flows? What happens? I'll explain later. You can also do based on comparable properties, and you can bring in anything, your wish. So valuation is something which is very subjective in nature, very subjective. I want to value Bharadwaj Institute. I'll say the valuation of Bharadwaj Institute is 1 lakh rupee per student. More the number of students, more is the value of Bharadwaj Institute. Less the number of students, less is the value of Bharadwaj Institute. Number of students typically denote what is the revenue potential of our institute. So I'll say 1 lakh per student. If we have 1000 students, 1 lakh into 1000 is the value of our institute. I want to value an IT company. I'll say I'm going to value an IT company as 5 lakh rupee per employee. More the number of employees, more is the revenue potential. Less the number of employees, less is the revenue potential. I want to value this property. I'll say rent into 20 times. Whatever is the rent they are earning, annual rent, multiply with 20 is the value of the property. So you can bring in multiple different ways because there are a lot of subjectivity which is involved. You need to give a logic for everything. That's the only thing which people expect. Give a logic for whatever valuation you want to do. You can bring in any aspect. You can say I want to do valuation like this, I want to do valuation like that. Anything is fine as long as you give a logic for it. Logic is something which is needed. In the practical world, you're going to make assumptions. In class you don't make assumptions because a lot of things are given straightforward to you, but in the practical world you'll have to make a lot of assumptions. So you need to give logic for every assumption you are making. Just give me a minute. Okay, now I'll tell you one of the simplest and the easiest way of valuing any asset. Value of any asset is present value of future cash flows discounted at required rate of return. Let's not worry about the technical wording and all. If you want to value any asset, this is one of the primarily used method of valuation. The objective is simple. What am I going to get out of this building? So the future cash flows. I want to discount at some rate. Why discounting? Because I'm getting it in a future period. So today value, if I want to apply some discounting rate. What rate do I apply? Somebody will say this property should give me 12% return. Discount at 12. Somebody will say no, I want 18% return. Discount at 18. Somebody will say no, I want 25% return. Discount at 25%. Whatever return you want. Want return 10%? Discount at 10. You want to return 20%, discount at 20. You want 30% return, discount at 30%. That's your wish. I leave it to you at what rate you want to do discounting, but you will have to discount the future cash flows. At what? At the investor's required rate of return. Let's do a valuation of this property now. Year, cash flow, PVF at, I want to apply 20% discount. I want a 20% return, so I'm planning to apply a 20% discount and DCF. You want to value this laptop, I can do the same thing. Year, cash flow, PVF, DCF, provided this laptop is going to give me revenues. I want to value a car which is used for commercial purpose. Year, cash flow, PVF, DCF, get to know what revenue you're going to get out of the car and do the discounting. You want to value Bharadwaj Institute, future cash flows of Bharadwaj Institute, discount at 20%, 10%, 15%, that's your wish, what rate you want to discount, but you'll do the discounting and get to the value of the property, value of the financial security, value of the any asset where cash flows can be generated. I want to value a car which I'm going to use for personal purpose. Sorry, you cannot do it because there you don't get future cash flow. Now, what you can do for valuation, there are other methods. You may want to do a comparable method saying that, okay, this car has more features as compared to the other car. The other car has a value of 4 lakh. This car can have a value of 5 lakh. The other car has a value of 10 lakh. This can have a value of 12 lakh. So you will have ways of doing valuation in case an asset is going to generate future cash flows. So value of an equity share is the present value of future dividends discounted at investors required rate of return. Value of a bond is the present value of future interest and principal payment discounted at investors required rate of return. Value of a property is the present value of future rental and the final sale value discounted at investors required rate of return. Value of Bharadwaj Institute is the present value of future profits or cash flows discounted at investors required rate of return. So anything you want to value in practical world, this is what you need to do. Obviously the challenge becomes this: if I ask you what are going to be the future cash flows of TCS, you will start struggling, because doing that calculation you need to first forecast the P&L, you need to forecast the balance sheet. Based on forecasting this, you will get the cash flows, and based on the cash flows you can do the valuation. Practically many companies do that. They forecast the future and based on that they arrive at a fair value. They'll say this company is undervalued, this company is overvalued. All that commentary will be passed based on the future earning potential, based on the future earning potential. Okay, let me now do the valuation of the building. Assuming I'm going to use this building for some 10 years or 15 years, let me keep it for 15 years is what I'm going to use. At the end of 15th year, I'll sell this building. At the end of 15th, I'll sell this building. I'm going to get a rental income of 10 lakh. 10 lakh is the yearly rental I'm going to get. This will increase at the rate of 5%. This will increase at the rate of 5% looking at the historical data. So these are the rentals starting with 10 lakh, it will go to some 19 lakh rupees. And in the end, I expect to sell this at some 3 crore 95 lakh rupees. These are just my expectation. You can arrive at your own expectation. You want to value a property where you are staying, please put this. Okay, you arrive at these numbers. Investor said he wants 20% return. So all this you would have learned how to get the discount rate factor and all. So 20%, these are your discount factors, and the DCF value is this. And according to this calculation, the value of the property is coming out to be 84 lakh rupees. It is just coming out to be 84 because the discount rate was huge. We have followed a discount rate of 20%. So getting some 4 crores after 15 years is just like 25 lakh rupees today. It's just like 25 lakh rupees today. So in effect, the value of the property is 83 lakh. Now, why does a sale happen? See, somebody is going to buy, somebody is going to sell. One, there are emotional factors because of which you buy. I'm not discussing that. If you are a rational investor, you would have done the same calculation. Like I did, you would do the same calculation. Only thing which can change is for you, this can be different. You may say it's not 10 lakh, we'll get 12 lakh rupees. And it will not increase at 5%, it will increase at 10%. You have your own expectation. Or you may change this. So these are the only two things which can change. You may have a different view, I will have a different view. My view is different. I say I want 20%, this property should give 20%, so I said 83 lakh is the value. You say no, this property can't give 20%, this property can give only 15%. The value will change significantly now. If you put 15%, the value changes to 1 crore 23 lakh. The value has undergone a change. So you believe the fair value is 1 crore 23. I believe the fair value is 83 lakh. You say you want to buy the property for 1 crore. I'll be happy to sell. You'll also be happy to buy because I feel the value is only 83 lakh. You feel the value is 1.23 CR. Whenever a transaction happens in the practical world, be it any security, any buying and selling happening, you need to have an opposite view. I believe this company will go down. You believe the company will go up. If everybody has the same view, no buying selling will happen. So the view has to be obviously different. So same with this property, you will have a different value. I will have a different value in mind, and accordingly the sale is going to happen. So the broad thing I wanted to just discuss is, in case you want to value anything in the practical world, just try to do this as an exercise. Please try to do a valuation of any building which you know, or the place where you are staying. If at all you could be in rented mode, or you could be in owning it. If you are in rented mode, you know how much rent you pay, so put the cash flows. You arrive at some 10-year cash flow, put a value, and then do some calculation just for your academic knowledge where you are practically applying it. Or if you're owning the property, you will know how much rental you can get, and then just put a number and then see what happens. So this is one easy approach of doing valuation. Apart from that, a lot of customized way which can happen. As I was saying that I want to value Bharadwaj Institute, I'll value on the number of students. I want to value TCS, I'll value it on the basis of number of employees. So depending on the right indicator for that industry, we will do fair valuation and then arrive at the value. Now, why are we understanding about valuation? One, there are a lot of financial securities which are there in the marketplace. So in case you want to do buying and selling of that, is there a problem? Water is leaking. Can you just change the space? I'll just sort out that issue. So in case you want to do a fair valuation, you want to arrive at a value of a property, you can arrive, sorry, you want to arrive at a value of a financial security, you can just arrive at the value of that financial security and then understand based on that what is happening, whether to buy or sell. At some stage, assuming you start your corporate journey, you become a CFO of a company, you want to acquire some company, you want to know what is the fair value. Valuation is going to help you in doing that. You want to buy some property, you may want to do a fair valuation. You want to buy some asset, you may want to do a fair valuation. So valuation is going to be very critical at multiple stages, because this is going to ultimately tell you that what should be the right value, or whether I can do a buying or selling of some asset or not. So buying or selling will happen without knowing the fair value. It is a difficult exercise to many of you. I'm not sorry, some of you could have started buying and selling some securities, if at all you have done, which I sincerely advise not to do at this stage. No buying selling of any stock, futures, options, nothing you need to do. I'll discuss different aspects at some stage. But if at all you have bought and sold, you wouldn't have arrived at fair value. Your friend will tell buy this, you will buy it. That's not the right way of doing things. So you just, somebody tells you at some stage, if at all you have bought and sold, you are, in fact, you ask me also, I'll say buy the share. You ask me a logic for it, I'll say it will go up. Then you'll ask logic, I don't have a reason. So that doesn't work. So without having a logic in place, please don't keep doing anything. So you need a logic. So at a CFO stage, when you're planning to acquire some company, how will you arrive at the fair value? There are a lot of things. See, whatever you're going to do, somebody is going to do and give it to you, but you'll have to make sense out of it. You will have to question assumptions, because in the practical world, what needs to be questioned is your assumptions which are being taken. So without knowing the concepts, you'll not be in a position to question what is there in the valuation. So fair value is going to influence finally the buying or selling decision. So that's the purpose we are going to do a fair value. In security valuation, we have equity valuation, we have debt valuation, which is bond valuation, we have hybrid valuation. What is hybrid valuation? Is a combination of equity and debt called as convertible instrument. And you will also have something called as money market instrument. These are four broad areas which are there, but as such I would have broken down this chapter into, I think, some 10 or 12 aspects. Not 10, I think. Okay, I've broken down into 7. Walters and Gordon's model, rights issue and buyback, valuation of shares, valuation of convertible bond, enterprise valuation, and money market instrument. Let's not worry about those technical names as of now, but there's a broad classification which I have done for this area. There's a base theory which is more useful to answer descriptive theory question and some concepts related to theory. I will decide at some stage whether I want to cover it in the class, because past batches I used to do a separate recording for it, because when I discuss a theory based area, there will not be much of your participation. So at that stage, because it's fully theory, I normally prefer to give it in recorded mode, where I do a separate recording at home and then give it to you. My old recording will not be useful because there are some additions which have happened. So I may do a separate recording if needed, or we will discuss it in the class itself, depending on what. Because when I discuss theory, the problem for me when I discuss theory is, because I'm discussing theory, I'm not able to get your attention at some stage, because I continuously discuss theory. It becomes difficult for a student to follow. So that's a challenge we have with theory aspect, but we'll see what needs to be done later. What I'll be discussing is the core concepts, the base concepts, the practical theory. How do you solve question? How different concepts have come? All that is going to be discussed in the class, and then only we'll move to the solving part of it. So we're going to start with something called this Walters and Gordon's model of valuation. These two also, if you are in the latest CA inter syllabus, you would have gone through. When I say latest, that the existing syllabus, you could have gone through these two areas called as Walters and Gordon's model. Major part of CA inter I don't want you to have, but some concepts, if you remember, you will find it easier to grasp. In my material, I think the last, if you look at the initial part, there will be CA inter concepts for something like that. I think some 4 or 5 pages of that will be there. It will be in the last few pages. CA Inter FM concepts, page 309. Some 3-4 pages could be there. This is something you can see it later, if at all you want to brush up those concepts which are there at CA Inter. Because what ICI used to do is, one question they used to pick it from CA Inter and ask it in CA Final. So whatever you do in CA Inter, it would have looked like a very simple problem when you would have done there. Just to give an example, leverages looks very simple when you do it. CA Inter, I say asked one exam something on leverages, students struggled because they forgot the formula. They forgot the formula, what was there in leverages. Suddenly in a question they added financial leverage, student is not able to proceed because you don't know that formula, you have forgotten, because obviously there is a memory issue which can happen. So okay, so we are going to start with Walters and Gordon's model. Now let's first discuss Walters model. Now what Walter said is, the value of any security, we are discussing only share valuation now, this is for security valuation. Just give me a minute. You can keep page 62 open in case you want to make some notes in page 62, make it. In case you want to make some notes in your notebook, you make it, but page 62 is where some of the points I'm going to discuss would be visible. So page 62 is what you can keep it open. Okay, let me first discuss Walter's model now. Now what Walter said is, the value of any security, the value of any equity security is combination of two things. Why will a person buy an equity share? What is the reason for buying an equity share? Tell me, what do you get out of an equity share? Dividend, what else? Okay, bonus, what else? Dividend, bonus, and I think I was expecting this capital gain or capital appreciation. Bonus is not a return. You'll understand why bonus is not a return later on when we discuss other concepts. There are only two reasons. One is dividend, second is capital appreciation. So Walter said the value of the share is combination of these two things: dividend, capital appreciation. There are two aspects which come out of it. One is the dividend which a security gives. Second, there is a capital appreciation which a security is going to give. Okay, now coming to the dividend aspect, what Walter said is that every security is going to earn some earnings per share. They can decide to pay it or use it for future investment. For example, TCS. I was just looking at the data of TCS today before coming to the class. The latest EPS of TCS was, I think, 120. In that, they paid a dividend of approx 48. These are not exact numbers because I could not get the exact numbers. I did some calculation and got these numbers. So 48 is what they paid us dividend. Balance 72, they said we'll retain. Why do I retain? Because I have future expansion projects, future purpose for which I want to retain this money. If you pay dividend, there is a value because of that. If you retain, it will lead to capital appreciation. It will lead to capital appreciation, which also gives a value, which also is going to give a value. So there is some retention which is going to happen, and there is some payout which is going to happen. Now, at CA Inter, you would have learned about something called as valuing a perpetuity. Assuming TCS will give you 48 rupees every year. TCS will give you 48 rupees every year. There's no change, no capital appreciation, zero capital appreciation and all. It will give you only 48 rupees every year. I want a return of 10%. I want a return of 10%. Equity share doesn't have an end. Equity share doesn't have an end. It will give you 48 rupees. You need 10% return, no capital appreciation, zero capital appreciation. How much will you pay for the share of TCS if this is the scenario? It will give you 48 and you need 10% return. Sorry, 480. Why 480? Because I pay 480. First year give me 10%. TCS saying take 48. Next year give me 10%. TCS saying take 48. Next year give 10%. TCS saying take 48. So you keep getting your 48 rupees every year. That's called a perpetuity. That's called a perpetuity. So the dividend which you get has a value called as D by KE. D by KE. That is that 48 rupees which they are going to give divided by the cost of equity. 48 divided by the cost of equity has a value. That is one segment of the value of any security. Now, I asked TCS, you said 48 by 10%. You gave me this, I'm happy. But you are retaining so much money, no? So then they are saying, whatever I'm retaining, the 72 can become 75 or 80 later on. So how does that become? So I give them 72. I told them to retain the 72. Now what TCS is saying is, on the 72, I will earn 15% return. I will earn 15% return on this 72 every year. I'll earn 15% return on this 72. Whatever you're retaining, I will earn 15% return on this. So 10 rupees 80 paise extra I will earn. I will earn. This, whatever they are retaining, technically becomes worth of 108. Technically it becomes a worth of 108 because they are going to earn 15% on this. They are going to earn 15% on whatever they are retaining. Whatever you are retaining, you are saying I'll earn 15% on that. I said I want only 10%. So if you retain 72 in future, the value of that is 108. The value of that is 108, and it's not 1 year value. It is going to be continuously coming. This is going to be continuously come. So there's another component of value which says E minus D. What is E minus D is what you retain. Earnings is 120, dividend is 48. So what you're retaining is 72 into R by KE. What is R is how much the TCS can earn. 15% TCS can earn. You wanted only 10%. This is also something which is going to come every year. So this finally divided by KE. Any amount which you want, which you are going to receive every year is called a perpetuity, and the value of that, for example, the easiest way of valuing this building will give me 10 lakh rupees every year. No increase at all. Growing perpetuity, we'll see it later. 10 lakh rupees, I want 10% return. 10 lakh divided by 10%, 1 crore is the value of the property. The easiest way of valuing every year 10 lakh divided by 10%, and we are done. This is the simplest and the easiest way of valuing a property or valuing any asset. So, one, it will give me D by KE. What is D by KE is every year I'm expecting that dividend will be there. Will this amount increase in future? Yes, this amount is going to increase in future because you're retaining. So that is why we have two segments of valuation. One segment, what you pay. Second segment, what you retain. So if you are paying 48 by 10% as a value. Second, whatever you're retaining. If you retain 72, say what this guy could have done is he could have done 48 plus 72 this side, and divided by 10%, I would have got a value of 1200. But what company said is, no, I don't want to retain 72. I don't want to pay 72. So I'll move it to the second segment. When you move to the second segment, the value of 72 can either magnify or go down depending on the earning ability of TCS. Depending on the earning ability of TCS. So whatever you're retaining technically has a multiplier on top of that. That 72 can get multiplied with more than 1 or less than 1 depending on the relationship between R and K. If TCS will earn 8%, and I want 10%, the 72 will become worth of 57.6. The 72 worth will go down to 57.6 in case TCS can earn only 8% and I want 10%. If TCS can earn more, it will have a multiplier effect. If it is going to earn less, it is going to reduce my value. Clear? So the value of share according to Walter model is, the formula is there in the theory, don't focus on the formula, the concept part just be clear. D by K. What is D by K? Is the dividend which you are going to pay. Why I am dividing by cost of equity? Because the assumption is you will get this amount, along with that extra can come, along with that extra can come. So every year if I'm going to get, it's a perpetuity, and according, we have learned that equity share doesn't have an end. Equity share doesn't have an end unless the company is going to be wound up. So it is a perpetuity. Plus, the formula is technically retained earnings by KE. D by KE plus retained earnings by KE, but retained earning has a multiplier on top of that. Has a multiplier on top of that. Why does it have a multiplier? Because the company says you leave 72, I'll increase the value or reduce the value depending on what the company does with that. So that multiplier is called R by K, and retained earnings is E minus D. Retained earning is nothing but E minus D. So D by KE plus E minus D into R by KE whole divided by KE. Whole divided by KE. And this will give me the value of the share according to the Walters model. The value of the share according to the Walters model is, there are two components to the value. One is amount which I'm going to pay you. Second is amount which I'm going to retain. Now just to give the numbers, this is before the class or yesterday I did this number. TCS today is quoted at 3515. The value of TCS, the share price is 3515. The book value per share is 247. You learn about some of these concepts later on. What is P multiple and all, let's not worry. The earnings per share was 120. The dividend per share was 48. You learn about later on how to calculate cost of equity and all. The cost of equity I did using beta calculation, and I assumed it is 11%. I just arrived at a value of 11%. So according to me, the value of TCS is 48 by 11%. 48 by 11%. That is 11% is the cost of equity, plus 120 minus 48. R by K needs to be done, divided by 11%. The R I think was, just give me a minute. R was 47% in case of TCS. R was 47% in case of TCS, and accordingly you will tell me what is 48 by 11%. 48, just give me a number quickly. What calculator is compulsory. If you are there without a calculator, I can't help it. 48 by 11%. Sorry, 436. 72 into 47 by 11. First 72 into 47 by 11 and then divide by 11%. Sorry, 27 279 2796. Okay, tell me total of this. See, broad number is fine. Yep, I'll discuss. Just give me some time. I'm going to discuss that. I'm going to discuss KER everything. Just give me a quick value. 436 plus 279. 31. Okay, 32. Okay, the value in the market was 3515. Walters model has given an answer of 3232. According to the Walters model, this company is overvalued. According to the Walter model, the company is overvalued. My answer, I got 3141 because the cost of equity was 11.16. When I did it 11.16. But just to discuss the concept, I took those numbers and showing you where TCS paid a dividend of 48. It retained some 72. Return on equity was 47. Cost of equity was 11. And then we get to the number. Okay. Now let me discuss each of the items which are there. First is, in the formula you saw dividend. She's calling. PC sir, just give me 2 minutes. I'm coming. Dividend. The first concept is dividend, which we need to discuss. So how much dividend a company is going to pay, they will decide what needs to be done. But when you solve a question, you will have to calculate dividend. So there are 2-3 ways of calculating dividend. One is EPS into payout ratio. Earnings per share into payout ratio. Payout is how much you want to pay out and how much you want to retain. There are two components of it. How do you calculate EPS? EAES by number of equity shares. All this could be there in the theory. You want to make running notes, please make it. How do you get EAES? PAT minus preference dividend. PAT minus preference dividend. So this is broad thing on, this is one way of getting dividend. One way of getting dividend is EPS into payout ratio. EPS into payout ratio. The other thing is some question will give you dividend rate. Some question will give you dividend rate. They'll say dividend rate is 40%, 50%, 60%. So dividend rate if they give, then face value into dividend rate. Face value into dividend rate. The dividend is face value multiplied with the dividend rate will give you dividend per share. And some question will use the word dividend yield. Yield means it is a percentage of market price. Rate is a percentage of face value. You will see practically many companies make this announcement. We are declaring 12,000 percentage dividend. These are announcements which companies keep making because they apply that rate on the face value. So TCS 48 rupees on the face value. If it's 10 rupees, it's 480%. But on the market price, it's only 1% because market price is some 3,500. So normally practical world dividends are 1% of market price, 1.5% dividend yield. But on the face value, it is going to be something like 500%, 600%, 1000%. So the dividend can be one payout ratio. If they give payout ratio, multiply on PAT or EPS. If they give you rate, multiply on face value. And if they give you yield, then market price into dividend yield. Market price into dividend yield. I'll just be back in 2 minutes. There's some requirement. I'll be back. Okay. So first thing I wanted to discuss was on the dividend aspect, which I said you can have three ways of calculating dividend depending on the question's requirement. And having clarity on this will be very critical because suddenly an MCQ question may come where this could get tested not here. It could get tested in some other chapter. That's first aspect. The second aspect is cost of equity. Now, what is cost of equity is technically called investors' required rate of return. There are ways of calculating cost of equity, which you will learn later. You have already learned about how to calculate cost of equity at CA Inter in your cost of capital chapter. An extension of that may come at few places. When I want to calculate cost of equity, at few places I'll discuss it. But otherwise, cost of equity is what does the investor want? Investors, I said investors required rate of return, present value of future cash flows discounted at investors required rate of return. That investors required rate of return is called cost of equity when you're valuing an equity share. It's called cost of debt when you're valuing a bond. It's called cost of preference when you're valuing a preference. It's called cost of real estate when you're valuing a real estate. So that cost name can keep changing, but that is nothing but investors required rate of return. You can give different names to it. It can be called investors required rate of return. It can be called as cost of capital. It can be called as cost of equity. It can be called as opportunity cost of capital. It can be called as the return which the company wants to give it to its shareholders. So different names can be given for KE. Then I had R. R is called return on equity slash IRR slash ROI. Different names could be there in the question. Return on equity or IRR of an instrument or IRR of the company. It's all basically how much is the company earning, what return the company is earning. So the dividend aspect I've discussed. Return on equity, internal rate of return, return on retained earnings, return on investment. These are different names which are there. Now, how do you calculate ROEs? Now, let's first understand, let's not discuss ROE alone. Return as a rule. The formula for return is what I get divided by what I give. This is the normal formula for any return. Return is nothing but what I get divided by what I am giving. For example, I want to calculate return on assets of a company. What does a company get out of the asset is profit after tax. So return on asset formula is profit after tax divided by assets. Divided by assets. Return on investment. Investment means capital employed in the business. It's called capital employed. What does a business generate is called EBIT. EBIT divided by capital employed. Return on equity. What do equity shareholder get is EAES. What do they give is value of equity. Return on equity is what do they get is EA, ES, and what do they give is value of equity. So anywhere you want to calculate return, this is the formula you will use. What am I get? Return on a fixed deposit. You earn interest of 6%. So they'll say your return is 6%, but the calculation is whatever that interest divided by what you gave as principal into 100 you do, you will get to the answer which is going to be 6%. So return is EAES by value of equity. EAES divided by number of shares is called what? EPS. And equity, if you divide by number of share, it's called book value per share. Value of equity. What is value of equity? Is equity capital plus reserves and surplus plus whatever retained earnings minus fictitious asset. You remove that, you'll get the value of equity in your books. You divide by number of shares, it's called book value per share. Book value per share. So either you can say EAES by value of equity, or EAES divided by number of shares is called EPS, and value of equity divided by number of shares is called book value per share. So you can say EPS divided by BVPS into 100. This is on return aspect. Clear? The other aspect was EPS. These were the four items which are there. One is dividend, second is EPS, third is cost of equity, fourth is return on equity. EPS part I've already discussed, which is EAES divided by number of equity shares. So this is how we are going to calculate the fair value of a share as per Walters model. Another challenge which you're going to face is question will give information. They'll not say which model to follow and all. Because here I've bifurcated Walter, Gordon, then you learn FCFF, FCFE approach. So all that I've done bifurcation. So whenever you see a problem where R, E, KE and ROE is available, we'll be able to do Walters model. We'll be able to do Walters model. Some of them may not be directly available. You may have to calculate it. Some of them could be readily available. But these are the four data points I'll have to search. What is, sorry, not R, D. Dividend, EPS, cost of equity and return on equity. Dividend per share, earnings per share, cost of equity and return on equity. If I have these information, I'll be in a position to calculate or value the share as per Walters model. So this is the formula. I'll just show it in your book now. D by KE plus R by KE into E minus D divided by KE. P naught is called fair market price because this is the value you are calculating. That's called fair value. The actual value can be different. D is called dividend per share, which is total dividend by number of shares, or EPS into payout ratio, or just right there itself. Face value into dividend rate, or face value into dividend rate. Face value into dividend rate. I don't know how much space you can manage, or market price into dividend yield. Face value into dividend rate, market price into dividend yield. Market price into dividend yield. Return R can be called as return on equity, internal rate of return, return on retained earnings, return on investment. Different names could be used. Formula is EAES by value of equity, or EAS divided by number of shares is called EPS. Value of equity divided by number of shares is called book value per share. E is earnings per share, which you know how needs to be calculated. This formula ROE is equal to EPS by BVPS. This goes the other side. This goes the other side. EPS is equal to return on equity into book value per share. EPS is equal to return on equity into book value per share. Cost of equity, there are multiple names. Investors required rate of return, opportunity cost of capital, rate of capitalization, cost of capital, equity capitalization rate. Different names can be there. How do you calculate cost of equity? You have seen it at CA Inter. Few places I'll discuss again. Few places we'll discuss how do we go about computing the, or how to calculate cost of equity. Any doubts on what is Walters model? Because I'm going to start solving questions. So, but before that, in case on the base, on the formula, if there is anywhere logical disconnect, let me know. Two components to the value. The first component is the dividend which you pay divided by cost of equity. Why I divide by cost of equity? Expectation is this amount will be paid every year. Along with that extra amount is called the second segment of the formula. The second segment of the formula is the extra amount which is going to come, which is the retained earnings. So the actual formula is D by KE plus retained earnings by KE, but retained earnings has a multiplier called as R by KE. Now net because of this what happens is there's something called as an optimum dividend ratio. Optimum means how much can you pay? What is the ideal payout ratio? It can range from 0 to 100, but Walter's model will either give answer as 0% or 100%. There are two answers only it will give. It will say optimum is 0, optimum is 100, or it will say optimum indifferent. Indifferent means you pay 1, 2, 5, 20, doesn't really matter. Now, in my TCS example, I said 120 is the price. Now, in case, assuming all these numbers are right, if TCS did not pay any dividend, if TCS did not pay any dividend, the Walters model would have given me an answer of 4,500. The Walters model would have given me an answer of 4,500 if TCS did not pay any dividend. Don't go into the calculation and all, just listen for the time being. If TCS had retained everything, Alternatively, if TCS had paid out entire amount, the value would have been 1075. The value would have been 1075 if it had paid out entire amount, and if it had retained entire amount, it would have been 4518. And for 40%, my value came as 3141. You had said some 3200, some value was there. Now, why did this value change? The important factor is this multiplier R by K. If R divided by K is more than 1, if R divided by KE is more than 1, then my entire value should come out of the second segment of the formula. First segment should become 0. The first segment should become 0 so that the entire portion is shifted to the second part of the formula. If R by K is greater than 1. If R by K is greater than 1. In short, if company says I can earn 15 and you want only 10, the company is telling I am giving you 15%. Why do you want dividend? I'll say don't give me dividend. Anyway, you're giving me more later on. You are giving me more later on. So if company can earn more than what investor wants, payout ratio is 0%. The optimum payout ratio is 0%. It will be there in the theory itself. The optimum payout ratio is 0% in case you can earn more than what is needed. You can earn more than what is needed. If you are going to earn 8% and I want 10%, I say you cannot retain any money of mine. I am a shareholder. You can earn only 8%. The company, I'm telling the company, you can earn only 8. I want 10%. So you give me entire amount to me. You give the entire amount to me. Don't retain with yourself. Don't keep the money to yourself. You give the entire amount to me because I will earn more. I will earn more. So if R by K is greater than 1, 0% payout. If R by K is less than 1, 100% payout. If both are same, indifferent, your wish. It doesn't really matter if R by K is same, because the formula will be 10 divided by 10% plus 1 by 1, because it's going to be the R by K is going to be 1. So whether you put the value in the first segment or in the second segment, it's not going to matter. So the optimum payout ratio depends on the relationship between return on equity and cost of equity. If the return on equity is more than cost of equity, then please no need to pay dividend. If return on equity is less than cost of equity, pay 100%. And in case both are same, I am indifferent. Your wish. You can pay any amount you wish to. Any doubts on this? This is a broad concept I wanted to discuss. There are problems which are going to be there. Some new concepts may come when I discuss a question, but broad concept, this initial theory, if you read, you will be in a position to solve the question. So that's how the theory has been given. So this is sufficient to answer whatever questions are there. Any doubts on this? Can we proceed? Clear? So the value is comprising of two components. One is dividend which is paid. Second, dividend which is retained and not paid. Dividend which is retained by the company and not paid. Paid portion is D by KE. Retained portion is retained earnings by KE with a multiplier called R by K. With a multiplier called R by KE. Clear? Any doubts on this? Done. Let's do a question now. Page 72, question 1. Go through the question. Okay. The earnings per share of a company is 10. Rate of capitalization is 10%. What is rate of capitalization called? Cost of equity. It has three options of paying dividend: 50, 75 and 100. This 50, 75 and 100 would indirectly indicate payout ratio. It can also indicate dividend rate, but that's not possible because face value is not there. The face value is anyway not there, because if 50, 75 and 100 is what is given in the question, I assume these are payout ratios. These are payout ratio. Calculate the market price as per Walter's model. If you can earn 15, 10 and 5, this 15, 10 and 5 is called return on equity. These are not three separate problems, these are 9 problems. How is it 9 problem? Because you can pay 50% and ROE can be 15, 10 and 5. You can pay 75%, ROE can be 15, 10 and 5, and you can pay 100%, ROE can be 15, 10 and 5. So totally 9 different situations are there. Let's write the formula. P naught is equal to P naught is equal to D by KE D by KE R by KE into E minus D whole divided by KE. R by KE into E minus D whole divided by KE. I'll do the first situation where the payout ratio, right? Payout ratio of 50% and ROE of 15%. Payout ratio 50%, ROE is 15%. 50 and ROE of 15%. What is the earnings per share? 10. So dividend is 5 rupees. You can write along with me all this. I'll tell you, in case my rule is, if I tell you please listen, that means I don't want you to write anything, else you can keep writing along with me. At some place I don't want you to write and only be in listen mode, I'll tell specifically. Pi was the cost of equity, 10%. I write it as 0.10. You can write it as 10% also. Few places student make mistake with percentages, so I better convert into decimal and write, but it's your wish. Even if you write 10%, technically same only. 5 divided by 0.10 plus, how much is the R? 0.15 divided by 0.10 into 10 minus 5 whole divided by 0.10. 0.15, 15% by 10% into 10 minus 5 whole divided by 0.10. 5 by 0.10 is 50. Second segment is 0.15 by 0.10, which is 1.5 times, multiplier is 1.5. It will become 75. 50 plus 75, 125. Any doubts on this? Clear? Looking at these numbers, can you tell me what is optimum payout ratio here? R and K, look at both the numbers and tell what is optimum payout. How much? 0 or 100. The logic is simple, no? Company is saying I am earning more than what you need, so company will keep the money. If investor is going to earn more, investor will keep the money. So if investor says I am going to earn more, that is cost of equity. See, what investor can earn is called cost of equity. What company can earn is called return on equity. Why do I need 10%? Because I can earn 10%. You want to keep the money, at least give me 10%. So if company can earn more, let the money be with the company. If investor can earn more, let the, so here ideal is 0. Now I'm going to make 75. As you increase payout ratio, value will keep going down. Value will keep going down because you are moving away from the ideal scenario. You're moving away from the ideal scenario. Situation 2. payout ratio of 75%, and ROE of 10%. Sorry, ROE of 15%. 15. Value will go down. Let's complete 50, 75, and 100. Payout ratio of 75, ROE of 15%. 75% is 7.5. So 7.5 by 0.10. 7.5 by 0.10 plus 0.15 by 0.10 into 10 minus 7.5 whole divided by 0.10. 75 plus 37.5. There's a value reduction which has happened. The value has gone down because you are moving away from the ideal scenario. You're moving away from the ideal scenario. As you move away from the ideal scenario, you will see a value depletion happening. So the value has gone down because we are moving away from the ideal scenario of the company. Clear? Any doubts on this? Situation 3, payout ratio of 100% and ROE of 15. Then we'll repeat ROE of 10%, then ROE of 5%. 10 by 0.10 plus 0 because you have paid out entire amount. You have paid out entire amount. Second segment is not there. Second segment is not going to be there because we have paid out the entire amount. 10 divided by 0.10 plus 0. So value reduced from 125 to 112.5 to 100 as you increase the payout ratio. This company, if it had worked with 0% payout, the value would have been 150. If you had done the calculation, it will turn out to be 150, which is not needed. But as you increase the payout ratio, value will keep going down. Clear? Any doubts on this? Next, situation 4. Payout ratio of 50% and ROE of 10%. Payout ratio of 50%, ROE of 10%. Five by 0.10, 0.10 by 0.10, 10 minus 5 whole divided by 0.10. 50 plus 50. It doesn't matter how much dividend you pay because this multiplier is 1. You repeat for 75, you repeat for 100, answer will be the same. 75% also will give you the same answer. 100% also will give you the same answer because we are indifferent. R and K is same. R and K is same. It doesn't matter what dividend you are paying. Situation 5 will be 75% and ROE of 10%. Seventy-five and 10. 7.5 by 0.10. After doing one scenario, it's more like a formality just to get more practice. 75 plus 25, 100. Payout ratio of 100%, ROE of 10. 10 by 0.10 plus 0 because you have paid out the entire amount. You have paid out the entire amount. Let me know if there are doubts. Quickly close the other three scenario. 50, 75, 100. Return on equity is 5%. Do situation 7, 8 and 9 where the payout ratio is going to be 50, 75 and 100. ROE is only 5%. 50%, ROE of 5%. 5 by 0.10, 0.5, 10, 75. 50 plus 25, 75 is the value. 0.05, the multiplier is 0.5 times now. The multiplier has gone down to 0.5 times. Earlier the multiplier when it was 15 by 10 was 1.5 times. Now the multiplier effect is only 0.5 times. Payout ratio of 75, ROE of 5. As you increase the payout ratio, value will go up. 87.5 from 75 it has gone up to 87.5 because you are moving towards an ideal ratio. 100% is the ideal payout in case R is less than KE. And last situation, 10 by 0.10 plus 0. When you have a 100% payout, it doesn't matter what is the R. When there's a 100% payout, R doesn't matter because the entire value will come from the first segment of the formula. The entire value is going to come from the first segment of the formula. So what Walter said is his logic is very simple. He said the value is going to be arrived out of two components. One is what you pay, second what you retain. Retention depends on whether you can have a positive multiplier or not a great multiplier, favorable or an adverse multiplier. A favorable multiplier is more than 1, which is possible if R is greater than KE. Adverse multiplier is less than 1, which is possible if R is less than KE. Clear? Any doubts on this? Any doubts on this? Done? Can you proceed? Done? Take it. I'll take a break of 5 minutes and then proceed. Okay, let's continue with some more problems in Walter's model. Let's come to question 2. You are requested to find out the approximate dividend payment ratio so as to have a share price at 56 by using Walter's model based on the following information available for a company: net profit, outstanding 10% preference share, number of equity share, return on investment, cost of capital after tax. Okay. In this problem, they have given the share price. Again, they specifically said Walter's model. There will be problems where the specific heading may not be there. That is Walters or Gordon. So, how to do there, I'll explain. But here they have told Walter's model. They want a share price of 56 and they have given certain data points and we are required to do it. So, I basically need dividend is what I need to calculate. Earnings is something there in the question. What is the return on R? What is R? 15%. What is KE? 12%. They've used the word after tax, doesn't really matter. There's no concept of pre-tax cost of equity. Cost of equity is always after tax only, because there's no tax benefit or angle as far as equity is concerned. So cost of equity is 12%. If at all, question says an investor wants a pre-tax return of 14%. Pre-tax return of 14%. Cost of equity is not 14%. That you'll have to convert into after tax. That you'll have to convert into after tax, because whatever company is paying as dividend, they are technically not taxable for the investor. So the rule is your numerator and denominator should be consistent. Dividend is tax exempt. Cost of equity should also be after tax. Cost of equity which you use should be after tax. So if at all a situation where they say the investor wants to earn a return of 14% before tax, then you'll have to convert that into after tax and then do the calculation. Let's start. Basic information. Basic information. Point number one, DPS, EPS, cost of equity, return on investment. These are the four things we capture: dividend per share, earnings per share, cost of equity, and return on investment. DPS is question mark, that's what we are required to find. Dividend per share is what we are required to find. Earnings per share is EPS is equal to PAT minus preference dividend divided by number of shares. PAT minus preference dividend divided by number of shares. EPS is equal to PAT minus preference dividend. PAT is how much? 50 lakhs. Preference dividend 50 lakhs minus 8 lakhs. 50 minus 8. 50 lakh minus 8 lakh. How many shares are there? 8.4. So EPS is 8.4. What's the cost of equity? 12%. Return on investment 15%. Let's put this in a formula. We want to arrive at a price of 56. Our requirement is price needs to be 56 rupees. Any doubts on the base data? Let's start. P naught is equal to D by KE, R by KE into E minus D divided by KE. P naught is equal to D by KE plus R by KE into E minus D divided by KE. Price which I want is 56. The price which I need is 56. Dividend is something we are going to calculate. What's the cost of equity? Sorry, 0.12, 0.12, 0.15 divided by 0.12. How much is the earnings? Minus D divided by 0.12. 56 is equal to D by 0.12 plus 0.15 by 0.12 into 8.4 minus D divided by 0.12. I'll make 0.12 as a common denominator for both. 0.12 is the common denominator. 0.15 by 0.12 is 1.25 times. 0.15 by 0.12 is 1.25 into 8.4 will give you 10.5 minus 1.25D. 0.15 by 0.12 is 1.25 into 8.4 is 10.5 minus 1.25D. minus 1.25 d, 0.12 goes the other side. Let me do the calculation. Let me know what is d. 0.12 goes the other side is equal to point. Complete this. I'll discuss a few points here. D turns out to be 15.12, which is more than EPS, so that is technically a challenge. Practically, it is still possible to do because you may pay out of your past earnings, but Walter cannot have that because Walter says same amount every year. So you cannot keep paying higher amount more than your earnings every year. That is not possible. Paying one-off scenario when COVID came in, profits are not there, but still you paid dividend. That's okay. So next is payout ratio. They wanted the payout ratio, dividend payout ratio, DPS by EPS, dividend by earnings, dividend by earnings, dividend per share by earnings per share. Let's complete and then I'll tell you the challenge which is there. What's the percentage you get? Obviously 180% is not possible. So ICI in their solution said this percentage is not logical. 180% is something which a company can't pay, and they said let the company pay 0% or some number they gave. I don't remember it exactly, but 180% is not a logical number. 180% is something which is not logical because I cannot pay more than my earnings because the Walters model wants you to do continuously. It's not one time. One off scenario is possible, but paying it continuously at 180% is not possible. So the conclusion which they gave was something like this. Payout ratio will have impact on share price, and the question can ask us to compute the payout ratio for a target share price. If the computed payout ratio is more than 100%, then the same is illogical, and ICA answer takes the payout ratio 0%. This is a solution they had given. Every point which you're going to see in that theory will get mapped to some question. So for example, in this point you can go and write question number 2. This point is related to question number 2. I'll not be doing this mapping of points later on. Later on you will have to read the point and do the mapping to 3, 4, 5, whichever question it is. Every question can have some points where mapping needs to be done. This question, whatever you have followed, the mapping will happen to question number 2. The mapping is going to happen to question number 2. Below the answer you can write payout ratio of 180%. Payout ratio of 180% logical is not logical, and hence the company will follow a payout ratio of 0%. Now I don't have an answer why not 100%. Company will follow a payout ratio of 0%. Now one thing which can be said why 0% they have said is your R in this question is greater than KE. The R is greater than KE, so that could be one factor why we have answered it as 0%. Some other question rarely if you get more than 180 and there R is less than KE, you can answer it as 100%. That is going by your optimum payout ratio. Any doubts on this? Can you proceed? go through question 3. Okay, almost similar to the earlier question. There's nothing much for you to see. Net profit is given, preference capital is there, number of equity shares is there, return on investment is there. I'll have to calculate payout ratio, but one important factor is missing. What is missing in the question? Cost of equity. If cost of equity was given and they ask me to calculate payout ratio, I can calculate. If they give payout ratio and then tell me to calculate cost of equity, that is also possible. Out of the four, one missing information I can tackle. Out of the four, either if EPS is missing and the other three is there, I need four things: dividend, earnings per share, return on equity, and cost of equity. In this question, earnings per share is available, return on equity is available, cost of equity is missing, and dividend payout needs to be calculated. So this was an exam question. ICA wanted to test the students' ability to handle this challenge. The solution said, I'm going to assume a cost of equity and proceed. I'm going to assume cost of equity and proceed with the solution. There are going to be two approaches. One, you assume a cost of equity. Second, I'll give you another approach, which I'll explain in some time. So in this question, you can assume any cost of equity other than 20. Don't make it 20 because both will get cancelled with each other. You will get stuck. 22, 18, 17. Don't take a very high number and all. 20, you don't take it some 40, 50% and all. Any number. I think ICA took a number of some 16% or something. I'll take that number and proceed. Any number is fine. Any number is fine. We'll assume a cost of equity and proceed. So I'm saying assume cost of equity 16% and give me the answer. You do the part one. That is, you do the first solution. I'll give an alternate solution. Cost of equity. Now write. Cost of equity has been assumed as 16%. Complete and let me know the dividend. Cost of equity has been assumed as 16%. KE assumed as 16%. Assume cost of equity as 16%. Get to the answer of dividend. The payout ratio I get is 52%. Assuming cost of equity is 16%. You want to take any other number, please take it. Doesn't matter. Any number other than 20%. Can you proceed? This is one option. There's a second option which I can follow. Done with this? Any doubts? If you're still doing, let me know. I'll wait. Any number you can take. You can take. I think you may get a negative answer. So some challenges you may get. More than 20 is also fine, but it may give a payout ratio which is more than 100% type. Or it may even give a negative answer. I haven't done it. I just didn't want you to take 20 because 20 and 20 will get cancelled. Your D and D will get cancelled then. Clear? Okay. Now there's another formula for cost of equity which is called 1 by P multiple. Listen for some time. I don't want you to write. Listen. This formula ideally should not be used, and it can be used in only one situation. What is that situation? I'm going to discuss. First, let me discuss what is P multiple. What is P multiple? Is price by earning. The name is price earning multiple. So price is called MPS by EPS. MPS by EPS is called P multiple. So technically what we are saying is cost of equity is equal to EPS by MPS, because I've done inverse. So cost of equity is equal to EPS divided by MPS. That's the formula I'm indirectly going to say. At inter level, you would have learned the basic structure of cost of equity, which would have said K is equal to D1 by P naught. D1 is the dividend, P naught is the price. Your cost of equity is based on the dividends which an organization is going to pay. In case you still want clarity, you may just want to brush up what you did at CA Inter. But cost of equity is basically depends on the dividends of the company. The logic for that formula was price is equal to dividend by cost of equity. Why dividend by cost of equity? Because you have to value a perpetuity. You have to value a perpetuity. So whatever dividends are the first segment of the Walters formula. First segment of the Walters formula, D by KE. D by KE. When you inverse this, you can say K is equal to D1 by P naught. So indirectly KE formula is dividend per share by market price per share. The formula for K is dividend per share divided by market price per share. This formula also had some changes. If you remember, there used to be something called as plus growth. D1 by P naught plus growth rate. Why growth? I'll touch upon, discuss later. But if you are inversing the P multiple, and using it as cost of equity, then that is possible only if EPS matches DPS. If EPS matches DPS. So in this question, if you take cost of equity as inverse of P multiple, the final answer for payout ratio will be 100%. The final answer for your payout ratio is going to be 100%. There have been few questions where ICI has used this formula because of lack of info, even in non-100% situation. Even in a non-100% situation, because of lack of information, no possibility of doing something, they've ended up following. But in case, in this question, I don't want to do 1 by P multiple. I'll show the answer. You're going to write it. But if you do 1 by P multiple, your final answer is going to be 100%. Final answer is going to be 100%. Why 100%? P multiple is MPS by EPS. P multiple, price by earning. Inverse is EPS by MPS. But cost of equity formula is DPS by market price. Dividend per share by market price. So if dividend is equal to EPS, you can do 1 by P multiple. And if you remember, if dividend is equal to EPS, payout is 100, retention is 0, growth is zero, because there was a formula for growth rate which is called return on equity into retention ratio. I'll discuss that formula when I do Gordon's model, but growth is going to technically become zero. So we are going to do an alternate answer where I'm going to do cost of equity as inverse of P multiple, but I'm telling you the payout ratio is going to be 100%. Payout ratio is going to be 100%. Next, alternate answer, P multiple is equal to MPS by EPS. P multiple is equal to MPS by EPS. You can start writing P multiple is equal to MPS by EPS. MPS is the price they wanted. What is the price they want? EPS is how much? 7 times. P multiple is 7 times. P multiple is 7 times. K is equal to 1 by P into 100 to express in percentage. 14 point, it's technically 28571 something, but 14.29. This can lead to some rounding of difference in the end. Else I should ideally get 100% payout. 14.29%. Any doubts on this? Clear? Apply the same formula, get dividend as balancing figure. K is 14.29. Get dividend as balance. Earlier you took K is 16%. You took K as 16%. Now take 14.29. Take it as 14.29 and then get to the answer. P naught is equal to D by KE. Every question which we have solved, the solution will be there in that other book which I have given you. But that is not to be used at this stage. Later on, in case you want to refer something in the direct solution, you can refer. Else, you'll have to keep making your notes. One four two nine. Here we have taken the cost of equity as inverse of P multiple. Ideally, that can be done only when you have a 100% payout. Else, doing that is not right. So the solution is finally going to throw up a payout ratio of 100%. So moment you make an assumption of inverse of P multiple, the question loses its relevance because answer is going to be 100% payout. The final answer is going to be 100% payout. Any doubts on this? Clear? Can you proceed? So you can finally write payout ratio is equal to 6 by 6, 100%. Payout ratio 6 divided by 6, which is 100%. Any doubts on this? Clear? Now, whatever you solved is basically this. It's there in the theory. Questioners ask for computing the payout ratio to achieve a target price. However, cost of equity is missing in the question. We can do the one of the following. Assume cost of equity and proceed with the answer. Take cost of equity as inverse of P multiple. However, this approach will lead to a payout ratio of 100%. So this is basically from question number 3. The mapping of this point is question number 3. This point, whatever we have done, it is mapping of question number 3. Every point will get mapped to some question or the other. Now, one important thing which I want students to do is every question you solve, you will have to make notes like this, because whatever we did today, you just read these 2 lines, you're done with whatever I've done for the last 1 hour. Because when you reach a stage of revision, you'll not be in a position to solve so many questions. So few questions, you'll just read these 2 lines and things will get recollected. Okay, this is what I need to do if this is the situation. So every problem, it's very critical for a practical paper, you start making good notes. Theoretical you make or you don't make, your wish. Theoretical people do make, but theoretical doesn't really matter, because theoretical you can keep reading at a faster pace. There are people who are able to read the entire theory in 1.5 days. But in 1.5 days, if I tell you to solve 600 questions, you'll not be able to do before exam. Before exam, doing 600 questions is impossible. Even if you mark some of the questions, you can do that, but other questions will have some concepts which you may miss out. So what I normally, when I'm going to give a last day revision material and all, but my expectation from students is you make these notes. Without these notes in place, you will not be, you'll not be in a position to do quick revision. Other challenges, I am, whatever notes I give is made by Dinesh Jain, so that is very useful for me when I read this. When you read this, you may feel, no, I shouldn't write it like this, I should write it like this, so that's easily understandable for me. So notes has to be specific to a person. Whatever said and done, because of laziness of students, I have been forced to give this. But technically this is not the right thing for you to use, because these notes are well understandable to me, because I made these notes. You make notes and give it to me, I will not understand, because you have your own way of writing notes. And when you make notes, you wanted to write something and your words will may explain something else, but you know what you are trying to do. So your way of writing only you can understand, and my way of writing I can understand. So that is why you will have to make your own notes. So every question we did today at home, basic expectation. Question number 1, simple problem on Walter's model, not to be seen before exam, not to be revised. If you feel it is simple, if you feel something is there, please write whatever it is there. Question number 2, I learnt this, so let me write this as a point. Question number 3, I learnt this, let me write this point. You did not learn anything, very simple problem, please say simple problem, not to be referred again. If it's a simple problem, not to be referred again. If it is, for example, if I have to make a notes, I'll say question number 1, concept problem can be revised to understand Walter's model. Question number 2, yeah, I think there was some adjustment saying that you will calculate a payout ratio. If it's more than 100%, we write it something like this. Question number 3, if cost of equity is missing. So these are my points, okay? Whatever makes sense to you. For somebody, it could be making a point saying that in question number 1, that payout ratio was given as 50%. So if question gives 50% and EPS, I want to assume it as payout ratio. Whatever is your learning, you see what is learning for you, and please make 2 lines. Ideal time to make the notes is after 9 p.m. in the class itself. That is, class gets over. If you can sit for 10 minutes, you'll be making it. You leave it at 9 a.m. I'm telling you, after 9 a.m., you start with your articleship work and you do it at the end of the day. You will take more time. It's your wish when you want to make notes, because everybody will have your own commitments. I'm not saying that after the class only you'll have to make, but please make notes. Again, my request, unless you make notes, that notes is called as last day revision of yours. That notes is nothing but your own last day revision, because covering SFM in 1.5 days is impossible. Again, I'm repeating, covering everything is going to become impossible unless you have your own notes. You have the approach of preparing, you'll not be in a position to complete it. Every practical paper, your own notes are going to be extremely valuable, extremely critical. The faculty can give any notes, your friends can give you notes, but that's not going to be that useful, because question number 1 looks very simple to 20% of the class. For 15% of the class, it could be slightly difficult. For balance, it's very difficult. Whatever it is, whatever is your understanding of the question, please make that notes, because that is going to be extremely critical. I will help you with the notes, but my notes are only useful for me. It's not useful for you. Again, I'm repeating. So you can use it as a reference, but please have the habit of making notes. Clear? Let's move to the next question. Go through question 4. Okay. X Limited has an internal rate of return of 20%, which is basically a return on equity. It has declared dividend at 18% on its equity share having a face value of 10 each. This 18% is called what? Dividend rate, because I'm going to apply this on the face value. Payout ratio is 36%. Dividend rate will give me the dividend. Dividend rate will give me the dividend. With dividend and payout ratio, I can get earnings. With the dividend, normally with earnings and payout, you get dividend. Reverse working with the dividend and the payout ratio, I am going to get earnings per share. Earnings per share into the P multiple. Why into P multiple? I'll explain. P multiple is MPS by EPS. This goes the other side. This goes the other side. So EPS into P multiple is going to be market price. EPS into the P multiple is going to be market price. Technically, Walter needs 4 information and you get price. Here, what has happened is the price is given in the question. Price is already given in the question by doing EPS into P multiple, whatever way you want to do. Dividend is there, earnings is there, return on equity is there, missing information is cost of equity. So it's not like the previous question where I can assume and all. Here the cost of equity needs to be calculated. I don't want to do it as 1 by P multiple also, because 1 by P multiple is not going to work because the payout ratio given in the question is 36%. So you cannot say cost of equity. Find the cost of equity. You cannot say cost of equity is 1 by P multiple. Cost of equity as 1 by P multiple will not work, because doing 1 by P multiple is not the ideal scenario when you have a payout ratio of anything other than 100%. Still, I'll use this formula in some other place where I don't have data. When data is not available, I may try to do it. But here I have information. See, totally 5 information we need. What are the 5 information? Is price, which is the end result, DPS, EPS, ROE, cost of equity. So last question we did, this was given. The last problem we did, this was not there, this was there, this was there, this was not there. So 2 items was missing, so I had to assume cost of equity and proceed. The last problem, I'm just discussing the last problem where cost of equity and dividend both were missing. In this question, dividend is given. In this question, dividend is given. So cost of equity, no assumption based. No assumption based. Let's start. Basic information. Basic information. Point number 1, DPS, EPS, cost of equity, return on investment, and price. 5 things. DPS, EPS, cost of equity, return on investment, and price. Dividend, EPS, cost of equity, return on investment, and price. Dividend is 10 into 18%. Face value into the rate. 10 into 18%, 1.80 per share. 10 into 18%, 1.80 per share. EPS is 1.80, 1.80. The logic is simple. Payout ratio is equal to DPS by EPS. So EPS is equal to dividend per share by payout ratio. Dividend per share divided by the payout ratio. So 1.80 by 36%. One point 80 by 36%. 5 per share. 5 per share. In short, 1.8 is equal to 36% of EPS. The payout ratio is 36%. So 1.8 is equal to 36%. EPS is balancing figure. Cost of equity question mark. Cost of equity is question mark. Return on investment 20%. Price is EPS into P multiple. Why EPS into P multiple is P multiple formula is price by EPS. EPS goes the other side. Or in other words, price earning multiple is multiplied on the earning to get the price. Price earning multiple is multiplied with the earning to get the price. Is multiplied with the earning to get the price. What are the multiple given in the question? 36.25. Clear? Any doubts on this? 5 into 7.25, 36.25. Can you proceed? P naught is equal to D by KE, R by KE, E minus D. This question will need some equation solving. P naught is equal to D by KE plus R by KE into E minus D divided by KE. $36.25 is equal to 1.8. I'll make K is a common denominator for both. 1.8 plus 1.8 plus was a return on equity point divided by KE 5 minus 1.8. 5 minus 1.8. KE goes the other side. 36.25 KE 1.8 1.8 0.2 into 3.2 is 0.64 by KE. The simplified version is 0.64 by KE. 0.2 into 3.2 divided by KE. Divided by KE. Further point KE 1.80 KE becomes common now. 1.80 KE plus 0.64. This KE you multiply there. 1.8 KE plus 0.64 divided by KE. KE goes the other side and the equation is 36.25 KE square minus 1.80 KE minus 0.64 equal to 0. 36.25 KE square 1.8 goes the other side minus 1.8 KE minus 0.64 is equal to 0. Now this becomes a quadratic equation which needs to be solved. One, there's a formula based approach which I don't remember. So if you remember that formula based approach, it used to be something like minus b plus or minus some square root 4ac, something was there. If you remember that, you do it that way. Else, in order to solve a quadratic equation, we need two numbers. We need two numbers. When you add them, you get minus 1.8. When you add them, you get minus 1.8. What is the multiplier of the outer number? 36.25 into minus 0.64. 36.25 into minus 0.64. Minus. So I need two numbers. When I multiply them, I get minus 23.2. And when I add them, I get minus 1.8. We need two numbers. When you multiply them, you should get minus 23.2. What is minus 23.2? 36.25 into minus 0.64, outer numbers. 36.25 k square minus 0.64. The multiplier of these two numbers is minus 23.2. The addition of two numbers should be minus 1.8 when you add them, because if you add 36.25 and 0.64, you will not get minus 1.8. So I need two numbers. Think and let me know what two numbers will fit in here. Two numbers which can fit in this equation. 4 and you'll have to do some trial and error only. 1 and 23.2 will not fit. 2 and 11.6 also will not fit. 4 and 5.8 will fit. 23.2 is the number. 1 and 23.2 is not going to fit. 2 and 11.6 is not going to fit. 4 and minus 5.8. 4 and minus 5.8. These two numbers, if you add them, you get minus 1.8. If you multiply them, you get minus 23.2. Any doubts? This is not related to your FM part, more of max solving. The two numbers, when I add them, I get minus 1.8. When I multiply them, I get minus 23.2. So the equation now gets expanded as minus 5.8 ke plus 4 ke minus 0.64 equal to 0. Minus 1.8 gets expanded as 5.8 and plus 4. Minus 5.8 and plus 4. Expansion is minus 5.8 and plus 4. Can you tell me 5.8 divided by 36.25 is how much? Is it getting divided? Sorry, how much you get? Okay, so I can say common number is 36.25 ke minus how much you said? 0.16 plus 4 into ke minus 0.16 is equal to 0. This is a way to solve your quadratic equation. I'm not getting into much details here. 36.25 k is common outside in these two. 36.25 k is common within ke minus 0.16. Other side plus 4 ke minus 0.16. Net I can say ke minus 0.16. 36.25 ke plus 4 is equal to 0. Ke minus 0.16 is equal to 0. That will give you ke. 36.25 ke plus 4 is equal to 0. That will also give you cost of equity. Two cost of equity you will get. 36.25 ke into ke minus 0.16 plus 4 into ke minus 0.16 equal to 0. Two numbers, when I multiplied, I wanted minus 23.2. When I added, I wanted minus 1.8, which is 4 and 5.8. The two numbers which is fitting in this equation is 4 and 5.8. Net I'll say k is equal to 0.16. When you solve this, k is equal to minus This is not possible. There cannot be a negative cost of equity. There cannot be a negative cost of equity. Max equation says if you put a negative number, you will get 36.25, but that's not possible. I cannot have a concept of a negative cost of equity. So the equation finally tells me cost of equity is 16%. The final answer is cost of equity is 16%. The cost of equity is 16%, and just to validate our answer, in this initial part, if I replace 0.16 and check, you will get the answer. Leave this 36.25, that is 1.8 by 0.16, 0.20 by 0.16 into 3.2 divided by 0.16. You should get 36.25. 1.8 by 0.16, 0.2 by 0.16 into 3.2 divided by 0.16. 1.8 by 0.16 is 11.25. 0.2 into 3.2 divided by 0.16. 25 put together is 36.25. Put together the number is 36.25. Any doubts on this? If there are doubts on the solving part, I'm not really worried much about it, because that's not the core SFM concept. But in case there are other issues, let me know. In case there are other issues with the question, let me know. Solving part, in case you're not sure, then you'll have to go to your quadratic equation formula, which is I think some minus b plus or minus square root of 4ac, something is there. So you can just refer that and then do it, you'll get the same answer. When you get the same answer, whether you do it this way or you do it in the solving approach. Any doubts? Can you proceed? K is equal to that formula DPS divided by, there's also a growth rate, no? So if you assume growth as nil, it indirectly means payout is 100%. Whenever you assume growth is nil, our indirect assumption is payout is 100%. If payout is 100%, directly do 1 by P multiple. Directly I'll end up doing 1 by P multiple. So that DPS by MPS is perfectly right. What you say is perfectly right, but growth is also there. And growth aspect, we cannot ignore it. So this is one part. The second part is they wanted the value using, I think, Walters model. They wanted the value using the Walters model. Assuming I was not to do Walters model, there's also Gordon's model, which you said D by P naught plus growth. I will tell you how to calculate growth. In this question, growth can be calculated. Growth is equal to ROE into retention ratio. I could have calculated the growth, which will give a different answer. Okay, I'm saying the same cost of equity you're not going to get, because Walter has his own way of calculating the fair value of share. So today the TCS is quoted at 3,500. You apply Walter model, you got 3,100. You apply Gordon model, you may get a different answer. You apply FCFE model, you may get a different answer. You apply comparison model, you'll get a different answer. You apply FCFF model, you'll get a different answer. So different models are there, because everyone has their own way of calculating. Because it is like I'm telling you 50 students to make your assumptions and so on. So Walter made certain assumption, Gordon said some assumption. So different people have different assumptions. Clear? So cost of equity could have been done as D by P naught plus growth rate. Growth could have been calculated. In this question, the growth is 12.8%. That is what the growth is going to be. You will learn it later, but the growth is going to be 12.8%. So the answer, can you tell me 1.8 divided by 36.25 is how much? 4 point plus 12.8. This is the answer under Gordon model. Don't worry about the calculation. Don't worry now. But Gordon would have given a different answer. 4.96 plus 12.8. Broadly, it is some 18 percentage type. Closer to an 18% is the cost of equity as per Gordon's model. Clear? Any doubts on this? This question, I think this was the situation. Cost of equity is required to be calculated and P multiple is given in the question. We'll have all information. K would be computed through reverse working and following quadratic equation. This was question number 4. This line was solved or was discussed in question number 4. So every line there will have some or the other linkage. Clear? I've kind of discussed with Walter's model. I may come back to Walter's again when I do along with Gordon. So I'm going to now discuss Gordon's model. We may or may not solve a problem today, but I want to discuss the core concept of Gordon model because this is something which you are going to use at multiple places. Now, let's just first understand with few numbers. I have a fixed deposit. I have created a fixed deposit. Year, listen mode only. Please be in listen mode. Year, opening balance, interest, payout, closing balance. Let's take an example of 5 years. I created an FD of 1 lakh. I assume the interest is going to be same for all the years. Okay. The FD gave me an interest of 10%. Gave me an interest of 10%. As a policy, I wanted to take out the entire amount. I wanted to take out the entire amount. I can add it to the FD also if I want. So my closing FD balance is 1 lakh plus interest and what I took out. Next year, my opening balance is 1 lakh. I earn, I take out, and the series goes on like this. This is one situation. Okay. Second situation is 1 lakh. I have a policy of taking out only 20%. Policy of taking out only 20%. So next year the opening balance increased. Again the opening balance increased. Again the opening balance increased. Again the opening balance increased. It kept on increasing like this. It kept on increasing like this. Now in this example which I've done, FD is giving me an earning of 10%. FD is giving me an earning of 10%. That's the return the FD is giving, or technically you can say that's like the cost of equity also. That's like the cost of equity because I wanted a 10% return. I wanted a 10% return from the FD and the company is also paying 10% only. Your ROE and K is same as of now. ROE and K is same. You also want 10% and company is also giving 10%. So cost of FD or cost of equity, let's call it as cost of equity only, 10%. Return on equity is 10%. You invested 1 lakh, next year it went up to 108, then it went up to 116, then went up to 125, and interest is also going up. Can you tell me what is the rate of increase in this interest? How much percentage is the increase? 2000 becoming 2160 or 10,000 becoming 10,800. How much is the percentage increase? So technically growth is 8%. Can you tell me what is the growth here? Clear? Growth is 0%, growth is 8%. Growth depends on two factors. One, how much interest the bank FD is giving. How much interest the bank FD is giving. So growth is equal to bank is giving 10%. Bank is giving 10%. And whatever interest they are paying, how much am I retaining in the FD? How much am I retaining in the FD? I am retaining 80%. I'm retaining 80% and paying out 20%. I'm paying out 20% and retaining 80% in the fixed deposit. Growth is 8%. I change payout to 30. I change the payout to 30. Retention will change to 70. Growth will go down to 7%. Growth will go down to 7. 10,000 became 10,700. 10,000 became 10,700. 11,449. Growth has gone down to 7%. In this case, payout is 100. Retention is 0. So growth became 0%. So first thing I wanted to discuss is growth. Growth is equal to how much the company is earning. How much the company is earning and or what rate the company is earning and how much is paid out and how much is retained. In simple words, this is EPS and this is DPS. Interest is what the company is earning. This is a company, not a fixed deposit. Now company is earning 10,000 profit, paying out 10,000. Company is earning 10,000, again paying out 10,000. Another company earning 10,000 but paying out only 3,000. So it is able to grow now. It is able to grow now. Clear? Any doubts till this? Okay, this is one aspect. So first aspect I want to discuss is growth. Growth is equal to return on equity or IRR, whatever name you, whatever was R in the earlier Walters formula, which can be ROE, which can be IRR, which can be ROI, which can be rate of retained earnings into retention ratio. So the first formula is growth is equal to ROE into retention ratio. Now the Gordon gave a formula. I'll first give the formula and then show it in this example. What Gordon said is your KE, which you said D1 by P naught plus growth rate. This is something you would have seen at inter level. An extension of this is KE minus G is equal to D1 by P naught, and P naught is equal to D1 by KE minus G. Let me use this formula in this fixed deposit example. This opening balance is nothing but the value of the company today. Opening balance is the value of the company today. So I want to value this company today. So what I'm saying is P naught is equal to D1. D1 means dividend of the first year. D1 means dividend of the first year, which is 3,000. Dividend of the first year is 3,000. Cost of equity is 10%. Growth rate is 7%. Growth rate is 7%. I'll touch upon the formula again in some time. Just listen for some time. Answer is 1 lakh. I can expand this as P1 is equal to D2 by K minus G. P2 is equal to D3. P3 is equal to D4. Now D2 second year dividend 3210 divided by 10% minus 7%. Tell me the answer. Which is the value at the end of first year or technically beginning of second year? Beginning of second year. You do next year. P2 is equal to D3 by K minus G, which is 3435 divided by 10% minus 7%. 10 minus 7, what's the answer you get? It will go on like this. It will go on like this. So every share, any company, whatever share they have, it is a perpetual inflow. It is a perpetual inflow. Now I want a return of 10%. I want a return of 10%. This return will come in two forms: dividend, capital appreciation. Dividend and capital appreciation, whatever 10% you wanted. Capital appreciation is growth. Growth is nothing but the capital appreciation. For example, 1 lakh went up to 107, 107 up to 114, that is 7%. Everything is going up by 7% here. Growth is not only the growth in earnings, growth is growth in earnings, growth in dividend, growth in value of the company. Everything will go up by 7%. So I want a 10%. I'm saying you want 10%. 7% I'll increase the price. He's saying great, give me only 3% more. Give me only 3% more. How will he give me 3% more? He is saying I'll give you dividend divided by P0. Now why we do D1 divided by P0 is you invest today, you'll get the dividend at the end of first year. You'll get the dividend at the end of first year. Perpetuity is always valued a year in advance. This is a area where 9 out of 10 students make mistakes. 9 out of 10 students keep making mistakes. Perpetuity is something I'm going to discuss at multiple places. Question will say company is going to earn a profit of 5 lakh in the 5th year and it is a perpetual inflow. You will do a perpetuity valuation. If you are earning it in the 5th year, the value for that will come in the 4th year. The value for that is going to come in the 4th year because you value, because I'll say 5th year cash flow value in the 4th year, you say 4th year no inflow. Doesn't matter because perpetuity is valued a year in advance. Because you do a wrong valuation, when you do discounting, you will get stuck. Your discounting part, you will get stuck. So Gordon's model is basically used to value a perpetuity, and what he said is there are two forms of return an investor wants. One is dividend, second is capital appreciation. Dividend is D1 by P naught. This is technically dividend yield. Capital appreciation is nothing but growth, but it is nothing but P1 minus P naught, that is the price increase divided by today's price. That's technically that. You need not write this formula, but P1 minus P naught divided by P naught. For both the numerator is P naught only. For both the numerator is P naught only. For example, it is 3000 by 1 lakh plus growth is 107 minus 1 lakh divided by 1 lakh. That's the cost of equity. That is the cost of equity. Dividend divided by the opening price, that is 3000 on 1 lakh plus 107 minus 1 lakh divided by 1 lakh, I get 10%. I'll end up getting 10%, 0.10. So the K formula which you learnt earlier, the logic was this: D1 by P naught is called dividend, plus growth is called capital appreciation. And when you interchange this formula, it becomes Ke minus G is equal to D1 by P naught. P naught is equal to D1 by Ke minus G. Any doubts on this? Most important factor is it has to be D1 and not D0. Whenever you do Gordon's model, our valuation says you will have to take the next year dividend. You will have to take the next year dividend. If you remember at inter level, this is one place where there will be a lot of confusion. The question will give you a dividend and you will not know whether it's D0 or D1. That will continue even at final level. In case it's not clear, we make assumption. And in fact, I give both the answer. Whatever dividend is given in the question, I'll assume as D0 and give one answer. I'll assume it as D1 and give one answer. But basic logic for this formula is here. The logic is the cost of equity, which is investors required return, has two components. One is dividend, second is capital appreciation. The same was Walter also, but Walter approached it in a different manner. He said dividend is this much, capital gain I'll value it differently. Here they are saying I'll go through the growth route. I'm going to go through the growth route. So growth is equal to ROE into retention ratio. Why ROE into retention? I explained you with that FD example. In the FD example, as you change payout, you change this to 50%, growth will become now 5%. Growth is going to become 5% because you have increased the payout. As you increase payout, growth will keep going down. You do 100%, growth is 0. Clear? Any doubts on this? So under Gordon's model, I need the next year dividend. I'm going to divide that by cost of equity. I'm going to divide that by the cost of equity minus the growth rate. Growth in few places can be 0. The formula remains the same. Minus 0 you will do. Now, for doing a Gordon's model, I need D1, KE and growth rate. For doing a Walter's model, I need D, E, ROE, KE. So KE I'll use here, D I'll use here. If these two are there, ROE and E, I'll do return on equity into the retention ratio and get the growth. So whatever 4 problems we did, all 4 can be repeated under Gordon's model. All the 4 can be repeated under Gordon's model. Why it can be repeated? Because you can calculate growth. You can calculate the growth rate. If you have information for Walter's model, all those problems, Gordon's is possible. But in some question, they'll directly give the growth rate. They'll not tell you how growth and all came. They'll directly give the growth rate. Then only Gordon is possible. Walter is not possible. You cannot go back to Walter. If they directly give you the growth rate, if they give you the breakup of growth rate as retention ratio so much, return on equity so much, then both Walter and Gordon will be possible. So every problem where Walter is possible, Gordon is also possible. You can do the Gordon's model for all those questions. Gordon is possible. But few Gordon's question, when you are going to solve, the growth rate could be directly given. if the growth rate is directly given, you may not be in a position to bifurcate that into ROE and retention. In that scenario, only Gordon's will be possible. Walter cannot be done. Clear? Any doubts on this? I'll just go to the theory part. So this is your Gordon's formula. P naught is equal to D1 by KE minus G, cost of equity minus the growth rate. P naught is equal to fair market price. D1 is equal to dividend of next year. This is one important assumption, as the question would not be clear whether it's a nearby dividend or distant dividend. Now understand one more concept. When I say D1 dividend of next year, that does not mean if you are in 23, 24 is next year. You are in 23, the dividend for 23 would be paid in another 5-7 months. Then that becomes D1. The concept is nearby dividend and distant dividend. What is nearby dividend? Is something which is going to be paid in the next 1 or 2 months. Something which you can visualize now itself and you are going to get paid. What is distant dividend? Is something which is going to be paid in 5-6 months or something which is going to take longer time. So if you remember in your investment accounting, you would have come across a concept called as X interest, cum interest. Similarly, we have something called as X dividend, cum dividend. An equity share will quote at cum dividend price, when dividends are likely to be paid in some days. Moment the dividend is paid, the price will go down by the amount of dividend. Moment the dividend is paid. Similarly, even in a debenture, moment the interest is paid, the cum interest will go down to the X interest. The cum interest value will go down to the X interest value. Similarly, the cum dividend price will go down to the X dividend price. So if any dividend is likely to be paid immediately, then that is called D0. That is called D0. If it's going to take longer time, for example, 2022-23, whatever dividends we are going to pay, that can be called as D0 now, because it's going to be paid in few months. Most of the companies would have closed their books of accounts. But whatever you're going to pay for the current year which is going on, that is not D0. Which is going on will become D1, because that will be paid only by maybe July 24 or May 24 or April 24. Some companies have a policy of paying interim dividend and all. Practical world, I'll get clarity. In exam, majority of ICA answer will have assumption of taking dividend as D1, and hence that would be our primary answer. Alternate answer will take it as D0 if it's not clear. If it's clear, go ahead. Wherever clarity is not there, our primary answer will take the dividend as D1. Alternate answer we will give, which will take it as D0. Why I'll give both answers is not going to take much time. There are few places where I cannot give multiple answers. Here I'll give both the answer because it's not going to take much time. Primary answer, whatever dividend is given in the question, is D1. Alternate answer will take it as D0. Cost of equity same. Growth rate formula based. IRR slash ROE. It's not IRR divided by ROE. IRR slash ROE into retention ratio. IRR slash ROE. It's not IRR divided by ROE. Some student had asked me this doubt, so I just remembered that. IRR or ROE, any of them can be used, multiplied with retention ratio. There's another formula. I'll explain that later. I'll explain that growth rate part later. Let's do maybe one question on Gordon's. Let's come to question 5. Go through this. Okay. Following information is collected from the annual report: PBT, tax rate, retention, number of shares, equity capitalization rate, rate of return, market price is 28. Advise whether the share of, it should be J limited, it's not Golden limited. I think there is some error either in the top or at the bottom. Should be purchased or not. Further, also suggest the form of market prevalent as per EMH theory. That next segment of the question you will not understand now. EMH theory is something I'll be explaining later. I'll tell you the answer which is there in the material. You can see the answer in the material also, but let's discuss the first part. Is the question anywhere saying follow Gordon's model? No. Read the question carefully and tell me, is Walters possible? Can you calculate dividend per share? Read data and let me know. Can you calculate dividend per share? Can you calculate earnings per share? Can you is the KE given? Is the ROE available? I'll wait for 3 minutes. Give me answer under Walters model. I'll do Gordon, but do Walters first. Do Walters model. In exam, one of the approaches fine. We prefer Gordon to Walter, but you first do Walter. You close Walters model. Walters is not asked also, but you do Walters model. Earnings is 3 rupees and dividend is 1 rupee 80 paise. There's a 40% retention, 60% payout. You can apply the formula and then get to the answer. 3 and 1.8. Earnings is 3 rupees, dividend is 1.8. Clear? And your answer is going to be D by KE R by KE into E minus D divided by KE. How much the cost of equity? 12%. 0.15 by 0.12. How much is the other side? 12.5. This is as per Walter's model. 27.5 is the answer as per Walter's model. And as per Walter's model, I should not buy this because the price in the market is more than what I thought. According to me, the fair value is 27.5. The price in the market is 28. So I should not go ahead and purchase this. This is the solution as per Walter's model. Any doubts on 27.5? Now, right, the actual price is 28, whereas fair price is 27.5. Fair price is 27.5. Share is in the market, the share is valued more than what is needed. So they are called as overvalued security. Share is technically overvalued. Why overvalued? Because it's more than the fair value. I will not buy it. Share is overvalued and hence we should not purchase it. This is the answer as per Walter's model. Share is overvalued and hence we should not purchase it. Clear? Next, alternate answer, Gordon's model. Each approach can give a different solution to undervalued and overvalued. One approach may say it's undervalued, another approach may say it's overvalued because they have their own way of calculating the answer and they have their own logic. Gordon's model. Any doubts on this, the earlier part? Now, right, P naught is equal to D1 K minus G. P naught is equal to D1 by K minus G. Whatever dividend is given, I'm assuming that it is D1 because I don't know whether it's this year. See, the question only said following information is collected from the annual report. It's collected from the annual report. I don't know when the dividend is going to be paid. Is it going to be paid immediately? Is it going to take time? I have no idea on that because dividend is going to be 1.8. When is it going to be paid is what very critical. ICA, whenever clarity is not there, most of the solution they take it as D1. So that's our primary answer and we'll give an alternate answer. So 1.8, I'll give a note on this in a minute. 1.8 was the cost of equity. 0.12 below growth is equal to ROE into retention ratio. Return on equity into retention ratio. Logic for this I explained with that FD example. Return on equity into retention ratio. What's the return on equity? Retention 6%. This would mean the fair price is 30 rupees. The fair price is 30 rupees. Current market price is 28. According to us, the price of the share should be 30. Market is saying 28. Market is undervaluing it. Market is undervaluing it. I'll go ahead and buy it. I'll go ahead and buy this. Any doubts on this answer of 31st? Clear? Now write a note. It is assumed, this note has to go in any Gordon's question. It is assumed that dividend of rupees 1.80 per share 1.80 per share is distant dividend, D1 is distant dividend, D1. This is more for your explanation. Distant dividend would be paid after 3 months. 3 is a fair indicator. Any time period after 3 months, okay? Could be fourth month, fifth month, sixth month, or you can write it as 6 months. That's okay. There's no practical world. There's nothing like what is the time period to be taken. But distant dividend is something which is going to take a longer period to pay. Nearby dividend is something which is going to be paid in the near term, which is going to be paid immediately or closer to the today's period. You can also write this: actual price is 28, fair price is 30, share is undervalued, and hence we should purchase it. Undervalued, so we should go ahead and purchase this. Any doubts on this? Clear? Just last point: alternate answer for Gordon model. Alternate answer for Gordon's model. Alternate answer for Gordon's model. DPS of 1.8 assumed as D0. Gordon's model, most of the question will give both two answers. One is taking as D0. DPS of 1.8 assumed as D0. So then P naught is equal to D1 by KE minus G plus 6%. Your dividend will grow at the rate of 6% because we have taken 1.8 as D0. We have taken 1.8 as D0. Similar conclusion could be given. That form of market theory I am not discussing now. It is there in the solution which is there. So the solution book is also there. You can look at that, but as of now you will not understand it. You will not understand much about that aspect. So that is something I'll discuss later. Form of market theory. Okay. Okay. Just to summarize what we did today, we started with Yeah. Oh, sorry. Okay, I don't have time to discuss the limiting value now because it will take. So next class, just remind me. I'll discuss limiting value of question 4. I missed it out. Sorry. Thanks. Okay. I'll just summarize what we did in Gordon's model. We initially started Walter's model. So Walter's model said the value of the share comprises of two components. One is the dividend which is going to be paid. Second, dividend which is not paid but paid future. So dividend which is paid is called D by KE, and what is not paid and to be paid in future is called retained earnings, which is E minus D, has a multiplier called R by KE, and again you divide by KE. So present value of dividends which you pay and which you are not paying, that is called Walter's model. Gordon said very simple: whatever dividend you are paying, I'll consider that only, but in your cost of equity, I'll remove the growth which is going to be there. I'll remove the growth component which is going to be there. So here also the same two segments. He also has same two segments, but the growth aspect is removed in the denominator. It is removed in the denominator, and based on that we get the fair value. I'll end with this today's session. We'll continue in the next class. I'll do that limiting value part in the next class. I'll end with this. If there are doubts, I can take it up.